Welcome to FMD Financial Monthly Economic and Markets Wrap. I'm Jeremy McPhail, Head of Investments. After we spoke last month, markets had a bout of volatility, which was due to happen as we were talking about volatility really dampening off in the month of March. That was down to higher than expected inflation rate, stronger than expected economic data points from both here and overseas, specifically in the US. Yeah, so the talk from the central banks in April is that the interest rates are likely to stay at a higher level for longer. Not looking to cut, not looking to raise, but looking to just remain stable until there's greater signs of easing in inflation rates. So that was a change in rhetoric and talk from the central bankers through the month, which put a bit of a volatility hit into the markets. Last month there was certainly a divergence in sector performance. So those sectors that are more impacted by interest rates, so real estate and discretionary type businesses, so those that are things that people would consider buying but aren't staples that you have to have. They underperformed as a result of the expectation that interest rates will remain higher. Commodities and materials, utilities, those that are related to commodity prices, which had a relatively strong month. People looking for hard commodities as a bit of a diversifier. Not that we're advocates for that, but it's certainly a way that markets sort of find avenues to find ways of making money in the near term. Longer term, we think equity valuations and equity fundamentals and bond and fixed interest fundamentals are preferred for long-term portfolios. I mean, the consumer and business confidence is quite weak at the moment. Certainly consumer confidence is the weakest that it's been for many years. On the expectation that the household budget is a lot tighter today than what it has been. Interest rates are definitely crimping what people are spending domestically, as we all know, and there's headlines for that all over the place. Bond yields in the month started around 3.9% here and ended about 4.4%. So that's for 10-year bond yields, and that's the market's expectations of longer-term interest rates, setting at a higher level on the presumption that economic activity is more resilient than what it was expected at the start of the year, and that central bankers will continue to remain on hold for a period of time. With interest rates staying on hold, the monitoring of inflation expectations and wages is something that the central banks will continue to monitor, as we've been talking about in these videos for a period of time now. And they're clear milestones that the central bankers are looking for, and I think that's what bond markets will be looking for. And all of that then sets the outlook and sets the return outlook for different asset classes, which will very closely be watched over the period ahead. Yeah, so the federal budget is coming up. There's clearly tax cuts that'll kick in, which is inflationary again, so that's something central bankers and the government will be very mindful of. So that's something to watch. There's clearly difficulty in a lot of households' budgets at the moment, so that's something that the budget may address, but I think it'll be on the periphery. I don't think that the budget will be looking to do anything significant in terms of spending, which would be inflationary, given the current situation in the economy. Markets have been relatively resilient to date. They've had a really strong 6-month period, and it's not without pause. It's worth seeing a bit of a pause in markets from time to time, that sometimes markets get ahead of themselves, and so you need to be a little cautious in those sorts of times. And that's when volatility kicks in, that you see some tension in markets that leads to that volatility. So it may be some sort of data point in inflation, it may be a data point in employment, it might be a data point in one of the big businesses that report that you may see that actually puts a bit of a rupture through markets that leads to some of these volatility pieces. being patient, being a patient as a long-term investor, that you need to take your mind off of these short-term positions and look at the long-term. Look at the long-term results from a 3, 5, 10-year type time frame. That is where generally wealth will be created or maintained, and avoiding the noise that happens in the market in the near term is psychologically something to certainly be mindful of and keep front of mind. But also, emotionally, it's difficult to ride the whims of the market, so you're better off not.